Well, this is a question I've been getting a lot lately, namely, what is going on with the euro US dollar exchange rate? Those of you who've been paying attention to this exchange rate have probably noticed that the euro fell below the value of $1 for the first time in 20 years. Back here in 2002 was the last time €1 was worth less than $1. Over the course of the 2000s, it went up as high as $1.60 in 2008, and really the story for the past 12 years, 14 years has been a decline in the euro versus the US dollar, now to a value of around 98 cents. Depending on who you are and how you were looking at the euro, this could be something that you find very, very exciting, or it could be something that you're somewhat worried about. But I'm going to try my best to answer in brief what is actually going on here. So, first of all, those of you might have noticed that this trend has really accelerated just in the past year. So, about 1 year ago, or a little over a year ago, this is May of June of 2021, €1 was about $1.22, and it pretty much fell off a cliff since then. So, over about a 20% decrease in the value of the euro against the US dollar just in the past 1 year plus. What's happened in that time? Well, let me bring up the next tab, which shows you interest rates in the two countries. So that brings me to this second chart right here. And sorry for the color mix-up here, but basically think of red and blue are the US interest rates, whereas white and yellow are the German interest rates. And this, unlike the last one, which is a 20-year chart, is a 10-year chart. Now you'll notice over here, that is that surge in interest rates that I was talking about. The most recent meeting with Fed Chair Jerome Powell was talking about his 75 basis point interest rate increase in the US. Basically, right now, the US bond market is telling you that short-term interest rates are expected to go up to around 4, maybe a little bit over 4%, whereas long-term interest rates, if you look at the 10-year bond yield here, the blue line, the 10-year is only going out to around 3.5%. Why does this make sense? You know, why would you, for example, be willing to lend money to the US government at a fixed rate of 3.5% when you can earn 4.1% committing to only 2 years? Well, basically, the bond market is not expecting rates to stay that high for very long. If you break it down, basically what the market is expecting is that the Fed is going to hike rates up to maybe around 4.5% at the most, but then it's going to have to cut after that rate chokes off inflation. One way that I often summarize this at 3.5% is what the bond market thinks is the long-term rate that the US economy can handle. Basically, think of that as an interest rate which compensates for inflation, expected to probably be around 2.5% to 3%, plus a little bit of economic growth and real return above that. By comparison, if you look at German rates were negative as recently as late last year. And only over the course of this year have they risen from negative territory up above 1%. But you'll notice that unlike in the US, 2-year interest rates in Germany are still a little bit lower than 10-year interest rates in Germany, and both of them are below 2%. Now, this can tell you a few different things. One, it tells you that the bond market doesn't expect the ECB to be as aggressive, probably because they realize the European economy is structurally weaker than the US economy, probably also because of very acute shocks to the European economy coming, for example, from the rise in gas prices due to the Russian invasion. Number of factors are going to keep long-term interest rates in Germany lower than long-term interest rates in the US. Demographics is, of course, another big factor. But why am I showing you a 10-year chart here instead of a 1-year chart or a 20-year chart? I wanted to show you how this situation has changed over the past 10 years. Since the time of the Eurozone financial crisis, back then, 10-year rates in Germany and the US were pretty close to each other, and 2-year rates in Germany and the US were pretty close to each other. This chart, I think, shows you a beautiful, great divergence between these two. Basically, what we've seen over the past 10 years is that US rates have largely risen together, German rates have largely fallen together and stayed lower than US rates together. That, I think, shows you how much the US and European economies have diverged, and that, long story short, is why I think the euro has declined against the US dollar over the past 10 years and is probably not likely to come back that quickly. Well, hopefully that was a good and thorough explanation. As usual, I would appreciate if you leave any comments below or send me any questions you may have. If this is a good format, I would love to do more videos like this in the future. Thank you.